Well, what we're seeing with the potential of a bank run, what's happening with the Silicon Valley banks, the domino effect this could likely cause. I also want to go into fractional reserve banking, which is actually the real cause of everything we're watching right now. I want to emphasize, folks. So I want to go over with you kind of the basics of what's happening, explain what this actually means for the economy, and also show what's happening currently, because I know there's a lot of noise right now and it's probably hard for people to make sense of what's going on. Basically, you have what looked like bank runs beginning. And with these bank runs, of course, the government is trying to step in to stop them. The Federal Reserve normally would try to stop them. The way that they're trying to stop them right now, and I should note it does not look like it's working. I'll show you the numbers in a minute. We'll get into that. It does not look like it's working. The way they're trying to stop this is basically changing the way that fractional reserve banking works. And frankly, this is probably going to cause unforeseen problems. They changed the way banking works, and I'm going to explain why that's actually really problematic. Briefly, and I'll go more into this later in the episode, I want to explain just briefly what fractional reserve banking is. This is something brought about by by centralized banking in general, but Federal Reserve in America really institutionalized it. This is what's happening. Basically, when you take your money and you put it in a bank, the bank does not actually keep most of your money there. The bank takes most of that money and puts it into, shares or investments or whatever else. In other words, they don't actually have your money. If you want, well, not a lot of it at least. So if people want to go and take their money out of the bank, it's, in a small scale, of course, it works. But if they try to take it out in a large scale, the bank does not have your money. They've taken your money and they've invested it in all kinds of things. The way this used to work traditionally, prior to the Federal Reserve in the United States, was that banks had to basically make sound investments. And they also had to keep enough money on hand if, for example, people wanted their money back. And of course, what happened prior to the Federal Reserve was that if people wanted their money back, or if the banks, made bad investments, the bank went under, the bank would fail. And of course, that created some problems because people would lose their money, frankly. And of course, the bankers would then be legally liable for that money, meaning the bankers took a huge risk on themselves. And because of that, they had to be very careful with the way they did things. The banks had it on themselves in terms of legal liabilities to make sound investments, to do things carefully, and to not take overly risky moves. That all changed with the creation of the Federal Reserve, and if you go to other countries with the use of centralized banking in general, because what the Federal Reserve does is basically bails out the banks. And they do this, ironically, through fiat currency, which is the paper bills you have in your pocket. Those are not federal notes. Those are Federal Reserve notes. If you pull a dollar bill out of your pocket, you'll see it says Federal Reserve note. They're not government issued. The government has allowed the banking system to basically issue tender, and those are basically notes suggesting a certain value. Now, the problem with that is that the way the Federal Reserve bails out the banks in cases exactly like this is through inflation. And so what they'll do is print more money. And by printing more money, they actually lower the true value of the dollar bills in your pocket. It's considered a hidden tax. It's one of the ways they rob you without you being aware of it. And basically, they can eat away at your savings, eat away at your money without you realizing it, just by printing more money. And that this is unfortunately the way the banking system bails itself out. How they how they transfer those costs back onto the taxpayers. And what we're watching right now is basically a move that is changing this whole system for the worse. Let me explain. All right, folks, I'm going to go a little in depth into this today, and stick with me because I'm going to be going into some of the problems with the banking system and some of the real problems that exist caused by, frankly, just what I would regard as the most corrupt institution in the world. Let's go into it, folks. So first of all, let me show you the Federal Reserve website. They had a new announcement. To give a basic picture of what happened, basically you have this bank, right? It's the Silicon Valley Bank. And the Silicon Valley Bank made basically a bad investment move. The Silicon Valley Bank, the one that started all of this, was basically, engaged in like ESG, environmental social governance policies. They were pushing for like gay rights and all these things like that, while not making very smart investments with their money. Basically, there was a very short-term increase in the amount of money they had, and they took that short-term money and put it into long-term investments, meaning it was a bad investment. Sure enough, they lost, right? It was a risky move, and they lost. Now what's happening is that people saw they lost, people wanted their money out of the bank, but the banks can only pay you back a certain amount of money in terms of what is insured by the system, $250,000 for most people, meaning, a lot of Silicon Valley, these tech startups and tech companies that have more than $250,000. And keep in mind, folks, if you own a house, your house is probably worth more than $250,000. For a lot of people, that's not a ton of money to have in the bank, especially if you're a business. That means that those businesses, those people who own, more than that and have that in the bank, basically we're going to lose all the money beyond that. That caused a run on the bank. People wanted their money out before basically they weren't able to give back the money, meaning you'd be able to only get back max $250,000. That was starting to have a rolling effect, not only just on, of course, Silicon Valley and on the people involved specifically in the Silicon Valley Bank, but on every single bank as well, tied into the FDIC system, because this is an insurance system, FDIC, right? This is an insurance system that has limited money. And so you might have seen news about, for example, First Liberty? I'll get into the names of the banks. I forget the names of all of them. But any bank that's under that insurance system, basically the insurance money available to those banks has been cut. And so all those banks that are within that system were also seeing basically the problem that they're not going to be able to pay people back. Meaning if you have money in the bank, you might not even be able to get it out. You might lose your savings. You might lose all your money, at least in the short term.